Hi everybody, and welcome back to video number 4 in chapter 13. And when we left off, we had finished alpha here and Bravo here, where we set up the effective interest method schedule. But we still need to do Charlie, which is preparing a journal entry to record the interest payment and amortization for 2025, and then the same thing for Delta for 2027. So under Charlie, we'll go back to our loan amortization schedule, and we will find those numbers here, and the premium here, and the cash will remain constant at $60,000. Okay, now we'll take a look here at describing accounting for the extinguishment of debt, paying off the debt. So, economic substance. If a company holds the bond to maturity, as I mentioned, both premiums or discounts will be fully amortized at the date the bonds mature. The carrying amount will be equal to the maturity or face value of the bond at the date the bonds mature. There's no gain or loss when we extinguish the bond, the debt. Okay, the company extinguishes the debt before maturity, however, that's a little different. The amount paid before maturity, including any call premium and expense, is called the reacquisition price. And on any specified date, the net carrying amount of the bonds is the amount payable at maturity, adjusted for unamortized premium or discount. Any excess of net carrying amount over reacquisition price is a gain from extinguishment, and any excess for reacquisition price over the net carrying amount is loss from extinguishment. And at the time of reacquisition, the unamortized premium or discount and any costs of issue applicable to the bonds must be amortized up to the reacquisition date. That's what you're going to do first. You're going to make sure that all of that has been amortized up to the date of reacquisition. So let's see how that works. Here is an illustration. On January 1, 2018, General Bell Corporation issued at 95 bonds with a par value of $800,000 due in 20 years. 8 years after the issue date, General Bell calls the entire issue at 101 and extinguishes it. At that time, the unamortized discount balance based on straight line amortization is $24,000. That's the time at the time of extinguishment. So, what entry does General Bell make to record the extinguishment? That's the redemption of the bonds. Okay, the reacquisition price was $800,000 times 101% given in the problem here. So that comes out $808,000. The face value is $800,000, but we have unamortized discount also given in the problem of $24,000. And if you wanted to calculate it, you could show that there's 12 periods, 12 years remaining on this bond at $40,000 a year. So we take 12/20ths of 40,000, we get 24,000. So that comes out $776,000, leaving us a loss on redemption of $32,000. Okay. General Bell records the journal entry for the extinguishment of the bonds as follows. The bonds payable, we're going to make that zero out. That's what's we've been carrying as a credit. Now we're debiting it to zero it out. We have additionally a loss on the redemption of the bond. That's going to be a debit, $32,000. We're going to credit the discount on bonds payable because that's what's remaining here as unamortized discount. We'll zero that out and pay cash of $808,000. Okay, so let's put it into practice. Here, good old J.J. Watt Incorporated had outstanding $6 million of 11% bonds with interest payable semi-annually on July 31st and January 31st, due in 10 years. Since issuance, market interest rates have declined, and Watts wants to reissue the debt at these lower rates. This exact situation is what I saw at Chrysler Corporation when we sold our bonds before the maturity date, because Chrysler had experienced severe financial difficulties and had to pay a premium interest wise to sell those bonds. But once they emerged from those difficulties, they saw no reason, Chrysler did, to continue with those bonds, so they bought them back. And that's the situation here with J.J. Watt. So on July 1, it issued $9 million of 10% 15-year bonds with interest payable on July 1 and January 1 at a discount of 98. A portion of the proceeds was used to call the 11% bonds, which had unamortized discount of $120,000. And they bought it back at 102% on August 1. So they want you to prepare the journal entries necessary to record the issuance of these new 10% bonds and refunding or buying back the 11% bonds. Okay, so to record the issuance of the 10% bonds, pretty easy here. The cash we got based on 98% of $9 million was $8,820,000, which represented a $180,000 discount. Bonds payable, again, what's written on the bond, $9 million. Now, to record the retirement of the 11% bonds, that one's a little different. First of all, we are going to debit bonds payable to zero out the $6 million. And we do the same thing for the $120,000 discount on bonds payable with a credit. Now, the loss on the redemption of the bonds, that's a little bit of a calculation here. So how we do that, our reacquisition price was $6,120,000, right? And so that face value was $6 million, but the unamortized bond discount was $120,000, given in the problem here. Okay, so we're going to subtract $120,000 from the $6 million, and that gives us $5,880,000, which we subtract from the reacquisition price of $6,120,000, leaving us a loss on redemption of $240,000 here. Now, that $120,000 again was the unamortized discount. Okay. Okay, So now let's explain the accounting now. We'll shift to long-term notes payable and away from bonds. Okay, accounting for notes and bonds is pretty similar, but not identical. So here, our bullet point 1, a note is valued at the present value of its future interest and principal cash flows. Now, while that's a true statement, we often don't need to go through that calculation because most of the notes are done at present in current day, which is already stated at present value. Under bullet point 2, the company's going to amortize any discount or premium over the life of the note if one exists. And bullet point 3, the companies compute the present value of an interest-bearing note, record its issuance, and amortize any discount or premium and accrual of interest in the same way they do for bonds. But again, oftentimes that's not necessary. All right, let's take a look at an example here. Scandinavian Imports issues a $10,000 3-year note at face value to Fjords Unlimited. The stated rate and the effective rate were both 10%. So Scandinavian would record the issuance of the bonds as follows. Pretty easy here. We're going to debit cash because we're receiving that cash, and we're going to credit notes payable because we have a formal written agreement. And then we're going to recognize interest based on straight line. Interest expense would be 10% of $10,000, and we'll credit cash to pay for that at $1,000. So that's pretty easy. Zero interest-bearing notes are a little more difficult. The issuing company records the difference between the face value, face amount, and the present value, the cash that we receive, as bullet point 1, a discount, and then bullet point 2, we amortize that amount, that discount, the interest expense over the life of the note. Let's take a look at an example. Turtle Dove Company issues a 3-year $10,000 zero interest-bearing note to Jeremiah Company, illustrated in Chapter 6, if you remember back, notes receivable. The implicit rate that equated the total cash to be paid, $10,000 at maturity, to present value was $7,721.80. Cash proceeds at the date of issuance, and the interest rate was 9%. So the present value of a dollar for 3 periods at 9% is 0.77218. So what is the time diagram and entry to record the issuance of the note? Well, here's the time diagram, and as you see, we're not paying any interest. Right? So essentially what we're doing is we're taking the cash here that we have and the notes payable at $10,000. That difference is a steep discount on notes payable here. Okay. And then if we take a look at a amortization schedule for that, we'll start off with our carrying value. We'll compute the schedule the same way we normally do, with the interest expense based on the effective rate times the carrying value, and the interest paid based on what's written on the note. And if we do that, we'll find that interest expense will debit for $694.96 and credit the discount on notes payable for the same amount. That looks like a good place for us to stop this video. And when we return, we'll take a look at an interest-bearing note. Until that time, bye for now.